Welcome to Keys Open Doors. Today, we're breaking down how big benchmark interest rates impact your path to home ownership. We're going to peel back the curtain on those massive financial numbers you hear about on the news and translate them into exactly what they mean for you, your wallet, and your future home.
If you're an aspiring home buyer, you've probably felt, a little overwhelmed by the constant barrage of economic updates, right? Yields are up, prime rates are steady, the market's shifting. But how do these intimidating daily market numbers actually ripple down to your personal finances? Are they just abstract concepts for Wall Street traders, or do they actively shape the size of the loan you can get for your dream house? Well, spoiler alert, they matter a lot. But you don't need a finance degree to understand them. You just need to know which numbers to look at.
Section 1. The interest rate landscape. The wholesale cost of money.
Think of money just like any other product. Before a bank or lender can offer you a loan, they effectively have to acquire that money first at a wholesale cost. The benchmark rate is that baseline. It's the foundational interest rate that massive financial institutions use to lend money to one another behind the scenes. From there, lenders add their own margins to cover risks and operating costs, and ultimately, that's how they arrive at the consumer loan prices you see advertised.
Section 2. Understanding the prime rate. Short-term borrowing basics.
So let's talk about the prime rate. This is the base rate that banks use to price short-term consumer loans. It's basically the economic engine behind the everyday borrowing you likely already use. We're talking about the interest rates on your credit cards, personal loans, or maybe a home equity line of credit.
Looking at where things currently stand, recent market data snapshots show the bank prime loan rate sitting at 6.75%. And when this number shifts, millions of consumers instantly feel the change right there in their monthly credit card statements.
But here is the secret that trips up so many everyday buyers. While that 6.75% prime rate is absolutely critical for your short-term debt, it generally is not the rate that dictates a classic 30-year fixed mortgage. It's a super common misconception. You might see a headline saying the prime rate didn't move and naturally assume your future mortgage rate is frozen too. But that's just not the whole story.
Section 3. Treasuries and your mortgage. The 30-year fixed engine.
Let me introduce you to the 10-year Treasury yield. This represents the return investors get on a safe 10-year government bond. Now, you might be wondering, why 10 years when a standard mortgage is 30 years? Well, historically, most 30-year mortgages are actually paid off or refinanced right around that 10-year mark. Because of that timeline, the 10-year Treasury yield acts as the true north for lenders pricing long-term debt. This right here is the dial you actually need to watch.
Let's look at the data again. Recent market information shows the 10-year Treasury yield hovering right around 4.56%. Here's how it works. When global investors are feeling cautious, they flock to the safety of these bonds, which pushes this yield down. When investors are feeling optimistic, this yield tends to creep up. And where this 4.56% goes, mortgage rates generally follow right along.
So we basically have two distinct lanes. On the left, the prime rate drives your short-term debt and credit cards. On the right, the 10-year Treasury drives your 30-year fixed mortgages. As an aspiring home buyer, understanding this difference empowers you to know exactly which benchmark to watch when you are planning out your standard mortgage.
Let's walk through this ripple effect in action. Step 1. A shift happens out there in the global market, and the 10-year Treasury yield moves up or down. Step 2. Almost immediately, mortgage lenders look at that shift and adjust their pricing to maintain their margins. And Step 3. That adjustment lands directly on the rate quote you receive from your loan officer. It is a direct chain reaction, literally straight from the bond market right to your future front door.
Section 4. Focus on what you control. Your personal financial readiness. We've spent a lot of time today talking about massive global financial benchmarks. But you know what? You can't control those macro markets. You can't dictate the Treasury yield. But you absolutely can control your financial readiness. You need to focus on your own microeconomy. Seriously, stressing over daily fluctuations in the bond market is just going to drive you crazy. Preparing your own financial house is what actually gets you across the finish line and secures you the best terms available when you're finally ready to buy.
In general, many buyers take these 3 foundational steps to make themselves the absolute most attractive borrower possible. First, improving your credit score. Second, lowering your debt-to-income ratio by paying down those credit cards, which, remember, are tied to that prime rate we discussed earlier. And third, consistently saving up for a solid down payment. Now, keep in mind, this is general educational guidance. I highly encourage you to consult a licensed mortgage professional to map out the exact right strategy for your specific situation.
Because when you understand the benchmarks, you completely remove the mystery from the market. You know what drives the rates, and more importantly,
You know what drives your personal purchasing power. Keys open doors, helping you unlock your path to homeownership. If this helped, like, comment, and subscribe.